So what is the difference between a cash account and a margin account? Well, I recently did a video talking a little bit about how you can grow a account under the PDT rule. So definitely check that video out. I also have a video on how much money you need to have in your account in order to make the number daily to get above the PDT rule. I was trying to explain that without giving too much away on the video. Anyways, welcome guys, Johnny Trades here, and today we're talking about a cash account versus a margin account. What's the difference, advantages, disadvantages, and at the end, I'm going to give you two examples on my WEBULL platform that should give you a little bit better understanding of exactly what it is we're talking about here. So guys, this is great. This is good news here, okay? There's two different accounts that you can use. Now you can use a cash account, okay? That is the simplest form of an investing account. You put money in. For example, you put $5,000 into your account and you have available $5,000 to use to buy whichever securities, stocks, ETFs you want, okay? Now on the other hand, a margin account is where you can simply put, say that same $5,000 and maybe you get 3 times leverage or 3 times margin. Okay, so now you put 5,000, but the margin account is allowing you 3 times more buying power. So now say you have $15,000 in buying power, okay, because you are using margin. Now, you can always open a margin account and not use margin. You could still use the money you have, say that same $5,000. Now, what are some key differences and benefits of both? Okay, well, the cash accounts are simple to use, they're simple to open. You don't have to worry about margin calls, and we're going to talk about that in a minute. It allows you to buy and hold. It also, most brokerages allow you to earn interest, okay? Even up to 5% on uninvested cash in cash accounts, okay? So it's like a really high yield savings account, which is better than most banks, okay? Now, some disadvantages, there are fewer kinds of trades available. You obviously can't take short positions. There's certain types of options you can't do, and the balance limits your potential return. So if you only have 5,000 and 2% of that is $100 a day, which is still great, it's a little bit more limited than, say, having $15,000 at 2%, right? Which would be closer to, what's that, $700, if I'm not mistaken. So with a cash account, you would only invest the money you have. Whereas a margin account, you can invest your cash and then borrow money with like a line of credit or extra buying power. Sometimes they can go up to 6 times or even 10 times your initial investment. So be very careful. It may sound great. Hey, let me put in $1,000 and get $3,000 to $6,000 in buying leverage, but also know your risk. And we're going to talk about that right now for margin accounts, okay? Now, margin accounts will allow you to also sell securities and use proceeds to buy more before it settles. Whereas a cash account, you have to allow 1 day to settle your funds. So if a cash account has $5,000 and you use all $5,000 on a Monday, you cannot take any more trades until the following day, which would be Tuesday, to allow your funds to settle, to allow your money in your cash account to settle. Now, with a margin account, if it's under the $25,000 or under the PDT rule, you can still, you only have access to 3-day trades, okay? Only have access to 3-day trades. But you could take all 3-day trades with the full amounts of money all on that Monday. So, same scenario as the cash account. If I have $15,000 in the margin and I use it on Monday, and I use all 3-day trades on that Monday, that means I traded up to $45,000 worth of trades in a single day. But now I have to wait over 5 days to take another trade. So that's why it's very important to be really specific on those day trades. And also when you're in a margin account under that $25,000 PDT rule, it's also better to limit your trades. Maybe you take a day trade on a Monday, Tuesday, Wednesday, or a Monday, Wednesday, Friday. And you spread them out a little bit so you always have access to at least 1 day trade when the opportunity comes about. That's why I like cash accounts a little bit more than margin accounts when you're under that $25,000 PDT rule. And if you're not sure what that PDT rule is, I have a full video talking about it. I'll link it up here or here, and you can watch that. But to keep it simple, a PDT rule is if you have, it is a pattern day trader rule, and if you have under $25,000, you will not be able to take more than 3 day trades, technically 4 day trades in a 5-day period. That's why a cash account is so great, because if I have $5,000 in cash, I could take 5 $1,000 day trades on a Monday, use all my money, it settles the next day, and then I have another 5 $1,000 day trades. Does that make sense? So by the end of the week, I could have anywhere from 5 to even 25 day trades in a single week using a cash account and using almost full size, compared to a margin account where I can only do 3 in a 5-day period. Now, I hope that explains it. I hope I didn't repeat myself too much, but I was trying to give you a couple different examples of what a cash account is and a margin account is. Now, smash that like button for me. We're going to go over what a margin call is right now. But first, I did notice that over 60% of you watching right now in the last 28 days are not subscribed to the channel. So do yourself a favor, and me one, subscribe to the channel if you find value in what I'm doing here. And while you're down there, smash that like button for me. Now back to the show. Okay, so margin accounts can be great. Okay, these can be great. Now there is interest rates, so we need to be very careful with margin. If it's under $25,000, Fidelity's interest rate's around 13%. If it's over $25,000, it seems to be around 12.5 to 13%. Now, let's walk you through a margin account real quick. Okay, margin accounts can be very useful, but can also be detrimental to your account. Okay, margin account real quick. Advantages of margin accounts: higher potential return because you get to borrow more money, access to more complex securities like trading futures, options, more complex securities, and gaining entries to more advanced secure investment strategies. Also, securing your loan with your portfolio. Margin accounts do offer you an easy way to borrow against your portfolio by taking out small loans. Okay. Disadvantages of margin accounts: high potential losses, minimum balance requirements, and margin calls can force you to sell. Okay, margin calls is what I wanted to talk to you about. If a margin to buy a security and its value drops below your $25,000 mark, so say you have $26,000, it goes to $24,000, you could get potentially margin called and forced to sell at a loss. Okay, that is not great. That is not great. So as it can be a great way to use a small amount of money, create some leverage, and use a more money, it's definitely very risky. Okay, so margin account, for example, you have $25,000. You're trading at $100. You buy 250 shares. It's $25,000. Say that you you can sell your position in your cash account if it goes up to 37,000. But what if the margin account and you bought it and it goes down? Okay, if it goes down to say 12,000, then you'll be forced to sell. You'll be more likely placed on a margin call, forced to sell at a loss, and then you wouldn't be able to wait for that to go back up or recover. Okay, so margin can be very risky. Now, if you want to learn more information on what a margin call is, and I can go into more details, short selling, and what a long position is, definitely check out some future videos by simply clicking that notification bell in down below, and you'll get notified when we make those videos. Thanks for watching, and we'll see you all in the next one.